Good afternoon, ladies and gentlemen. I am Ichikawa of Heiwa Real Estate Asset Management. I'm pleased that so many of you came to Analyst Meeting of Heiwa Real Estate REIT, despite your busy schedule and hot weather. Thank you very much indeed. Now I report on financial results for the 21st fiscal period, ended May 2012, and explain future management policy based on the material distributed to you. Please turn to page 5, indicating financial highlights. Operating revenue was up 112 million yen from the 20th fiscal period to 4,223 million yen. I'll give you the breakdown later, but revenue increased mainly because we newly acquired an office building in Nagoya, and occupancy of existing offices and residence was very strong. Operating expenses increased by 122 million yen from the 20th fiscal period. Main factors include an increase in expenses of leasing business due to newly acquisition of a property, an originally scheduled increase in maintenance and repair fees of offices and residence, and an increase in leasing cost of residence. General and administrative expenses were up, partly because we reacquired engineering report of or part of properties. As a result, operating income was down 9 million yen from the 20th fiscal period to 1,810 million yen. Non-operating expenses were up 17 million yen from the 20th fiscal period. Main factors include an increase in expenses due to new borrowing and a decrease in interest expenses on investment corporation bonds as a result of partial retirement of investment corporation bonds by purchase, which I'll explain later. Consequently, net income was down 22 million yen from the 20th fiscal period to 1,073 million yen. EPS was down 33 yen from the 20th fiscal period to 1,541 yen. We forecasted 39 million yen of negative goodwill applied, as we had no plan of new acquisition of a property originally. However, as revenue was higher than the forecast, therefore, negative goodwill applied was down to 5 million yen. As a result, we decided to pay distribution of 1,550 yen per unit in line with the original forecast. Please turn to page 7. In the upper chart, you see comparison and performance forecast with results, and as you see in the lower part of the chart, negative goodwill applied was 5 million yen, although the original forecast was 39 million yen. Operating revenue of existing offices and residence was higher than the forecast. Occupancy rate of office buildings, including newly acquired office, was 95.91%. Occupancy rate of offices, excluding a newly acquired office, was 96.95%, which is higher than the forecast we made in the 20th fiscal period of 96.93%. Occupancy rate of residence was 95.05%, which is slightly higher than the forecast of 95.01%. Higher occupancy rate contributed to an increase in revenue. Let me move on to portfolio condition indicated in the lower chart. As we acquired the property, total asset increased to 132.1 billion yen. The number of office properties increased by 1 to 22. The total number of properties was 88. As I explained earlier, both period end and period average occupancy rate exceeded those of the 20th fiscal period. As indicated at the bottom, portfolio NOI yield was 4.76% in the 20th fiscal period and improved to 4.82% in the 20th fiscal period as a result of an improvement in NOI yield of offices associated with newly acquisition of a property. Please look at page 8 next. This is a chart summarizing challenges and efforts for the 21st fiscal period. In June last year, or the beginning of the 20th fiscal period, we entered into the stage 2. Towards the phase of regrowth, we steadily made efforts to work on challenges we set in external growth, internal growth, and improved financial base. There are 3 main points. In external growth, we newly acquired a property. In internal growth, we maintained high occupancy rate and occupancy rate increased. In improved financial base, we finished addressing redemption of investment corporation bonds amounting to 10 billion yen, maturing in October this year ahead of schedule. I will give you the details later. Please turn to page 9. For external growth, we acquired an office building called Hirokoji Aqua Place in Nagoya. It is a relatively new office building and has high visibility and convenience as it faces Hirokoji Dori, an arterial road in Nagoya, and allows use of 2 subway stations and 2 subway lines. It is an 11-story building. The area of leased rooms on a standard floor is about 220 tsubo. In Nagoya, I think it is categorized as a large building, but we consider it a medium-sized building. As for characteristics, it has a parking lot which can accommodate 145 cars. It is also close to an entrance of an expressway. I think it matches the needs of companies holding commercial vehicles. That's why we acquired the building. It is the first property we acquired using warehousing function of our sponsor, Heiwa Real Estate. Heiwa Real Estate acquired the building in December last year and sold it to our REIT in March this year. Occupancy rate at the time when Heiwa Real Estate acquired the building and in March when we acquired the building was 83.58%. But Heiwa Real Estate worked on leasing and occupancy rate increased to 92.7% at the end of June. It means the building was incorporated in our portfolio after occupancy rate was up. Acquisition price was 2,930 million yen, while appraisal value is 3,710 million yen, leading to latent gain of 780 million yen. Expected NOI yield is as high as 7.35%. It is NOI yield at cruising speed, assuming occupancy rate at 90%. In the first period, public charges and taxes were not posted. Besides, maintenance and repair fees were not so big. Therefore, real NOI yield was 8.36%. Please turn to page 10 next. This page shows internal growth history of occupancy rates. In the graph, the blue line indicates office occupancy rate. In March 2012, occupancy rate dropped. It is because the occupancy rate of Hirokoji Aqua Place in Nagoya that I just explained was initially in the low 80% range. On the other hand, in the chart, office occupancy rate except Hirokoji Aqua Place is also indicated. Period average office occupancy rate of the 21st fiscal period was 95.91%, while existing office occupancy rate except Hirokoji Aqua Place was 96.95%. Occupancy rate was up 0.9% from 96.04% recorded in the 20th fiscal period. As you see in the graph in the lower left, period average combined occupancy rate increased from 94.7% in the 20th fiscal period to 95.55% in the 21st fiscal period. Please look at page 11. We finished addressing redemption of investment corporation bonds. In October this year, 10 billion yen investment corporation bond number 2 is to mature. As we had bitter experiences in the past, we wanted to get rid of risks associated with redemption of investment corporation bonds early and worked on this issue as the highest priority issue. From January to March this year, we implemented partial retirement of investment corporation bonds by purchase amounting to 1 billion yen. For the remaining 9 billion yen, we concluded commitment-type term loan agreements and got rid of risks associated with redemption of investment corporation bonds, finishing addressing the issue. We also made efforts to extend and diversify repayment periods and reduce financial costs. As for commitment-type term loan, the Nomura Trust and Banking and Mitsubishi UFJ Trust and Banking newly participated this time as lenders, broadening lender base. Please turn to page 12, which indicates debt financing status for the 21st fiscal period. As you see in the upper left, we newly raised 3 billion yen to acquire Aqua Place. We raised 3 billion yen from Sumitomo Mitsui Banking and the Bank of Tokyo Mitsubishi UFJ combined. The loan period is 3 years, 7 months. On the other hand, as you see in the upper right, at the end of May, we refinanced the loan of 6,130 million yen. We refinanced the loan by using the loan from Aozora Bank and Risona Bank again. Loan period increased from 1 year to 5 years, 5 months. As for interest rate, spread of the previous loan was 1.7%. After refinancing, interest rate was fixed at 1.89%. Loan period of 5 years, 5 months is the longest period since IPO of Crescendo Investment Corporation, the predecessor of HFR. Prior to the refinancing, the longest loan period was 5 years. Going forward, we would like to make various efforts to prolong repayment periods. As you see in the lower half, in order to hedge risks of rising interest rates, we purchased interest rate caps. There are 3 loan agreements, including term loan 10, 11, and 12, totaling 14.6 billion yen. As indicated in the right-hand side, ratio of fixed rates after application of interest rate caps is 75.30%, which means an improvement in ratio of fixed rates. Please look at page 13. This page shows history of maturity ladder. In the middle of the chart, maturity ladder at the end of the 21st fiscal period. At the bottom, for reference, maturity ladder after implementation of commitment-type term loan is indicated. Balance of interest-bearing liabilities increased by about 2 billion yen as a result of acquisition of a property and retirement of investment corporation bonds by purchase. Interest rate in the 20th fiscal period was 1.86% and will be 1.72% after implementation of commitment-type term loan. As you see in the right chart, after implementation of commitment-type term loan periods will be lengthened and loan maturities will be diversified. Amount of refinancing per period will be around 6 billion yen, leading to a very stable maturity ladder. Page 14 shows status of lender composition. As I explained earlier, Nomura Trust and Banking and Mitsubishi UFJ Trust and Banking participated as new lenders in the commitment-type term loan. The number of lenders increased from 10 to 12 banks, giving depth to the lender composition. Besides, we are seeing a gradual improvement in diversification of lender shares. Please turn to page 15. This page shows condition of interest-bearing liabilities. LTV in the 21st fiscal period was 45.7%, up 0.7% from 45% in the 20th fiscal period. We saw a big improvement in financial conditions. We don't think slight increase in LTV will be a risk factor. However, as I'll explain later, as we set restoring of A credit rating as soon as possible as our big challenge, I think it is important to control LTV cautiously. Please turn to page 16. This page shows forecast for the 22nd fiscal period. Operating revenue is forecasted to be up 22 million yen from the 21st fiscal period to 4,245 million yen. Hirokoji Aqua Place, we newly acquired, will make a full fiscal period contribution, which is a factor increasing revenue. On the other hand, we expect revenue of existing offices and residents will be slightly down. Key assumptions are shown in the lower left. As for occupancy rates, as I will explain later, the number of evacuations of offices slightly will increase. Besides, off-peak season will start for residents. Therefore, we made a slightly conservative forecast for occupancy rates. Occupancy rate for total portfolio is forecasted to be 95.32%, down slightly from 95.55% recorded in the 21st fiscal period. Of course, we will not target 95.32%, but make efforts so that occupancy rate will be flat or up from the 21st fiscal period. Operating expenses are expected to be up 94 million yen from the 21st fiscal period to 2,507 million yen. Breakdown is shown in the right chart. Maintenance and repair fees will be big, up 96 million yen from the 21st fiscal period. As I discussed at the last analyst meeting, we will implement repairs ahead of schedule in order to increase appeal to potential tenants and to mitigate future risks such as those posed by earthquake. We will actually implement them. We expect to spend about 100 million yen for maintenance and repair. CapEx is forecasted to be 30 million yen. In the 22nd fiscal period and the 23rd fiscal period, we plan to implement those works ahead of schedule. As a result, net income will be down 82 million yen from the 21st fiscal period to 990 million yen. EPS will be down to 1,423 yen. As I said, we will implement strategic repair works ahead of schedule, which is a factor reducing EPS. In real terms, we will be able to pay distribution of 1,560 yen per unit. By applying negative goodwill of 95 million yen, equivalent of repair expenses, we will pay DPS of 1,560 yen. Please look at page 21, skipping a few pages. Detailed data of offices and residents are shown. In the graph, the black line represents turnover rate converted to annual basis. In the 21st fiscal period, turnover rate was 6.81%. In the case of offices, and 6 months prior notice is required, cancellation for the 22nd fiscal period is already fixed, and turnover rate will be 6.71%, which is higher than turnover rate recorded in the 19th and 20th fiscal period. However, we consider turnover rate is stable at low level. For reference, 6.71% of turnover rate in the 22nd fiscal period based on 6 months prior notice of termination is attributable to 10 tenants. Out of the 10, 5 tenants will relocate for expansion. Although they are our tenants, there are no spaces meeting their needs for expansion in our vacant spaces. That's why they have to move. half of them out of 10 will move for expansion. In the 21st fiscal period, out of the 9 evacuating tenants, only 1 tenant relocated for expansion. It means relocation for expansion is increasing, and we can feel leasing market is gradually improving. Rent levels are indicated in the lower chart. Monthly rent per tsubo at the end of the 20th fiscal period was 17,598 yen and was 16,575 yen at the end of the 21st fiscal period. Hirokoji Aqua Place is large scale and rent per tsubo is low, pushing down average rent level. The number in the bracket excludes Hirokoji Aqua Place. In relation to 17,598 yen at the end of the 20th fiscal period, during repair works, tenants' rent was reduced or exempt. The figure includes impact of reduced or exempt tenants' rent. If we exclude the irregular factor, monthly rent per tsubo was 17,740 yen. Let me correct the number. It means monthly rent per tsubo was down 1.7% from the end of the 19th fiscal period. Compared to 17,740 yen, monthly rent per tsubo of existing properties at the end of the 21st fiscal period was 17,585 yen, which was a decrease of 0.9%. As market rents impact rents for new tenants, rents are still showing downward trend. In addition, we are still receiving requests for rent reduction from existing tenants, although the number of such requests is declining and rate for reduction is shrinking. In total, downward trend is still continuing. As for the gap between market rent and our contract rent for existing tenants was 17.38% in the 20th fiscal period. As we updated the market rent in the 21st fiscal period, gap increased to about 18%. For reference, if we exclude Kayabacho Heiwa building, the gap in the 20th fiscal period was 12.4% and 13.3% in the 21st fiscal period. The gap widened. The number of new tenants in the 21st fiscal period was 10. As indicated in the chart in the middle of the page. Out of 10 new tenants, 2 new tenants pay a rent higher than market rents. Remaining 8 tenants pay a rent within the range of market rents. There will be more new tenants which will pay a rent higher than market rents. Because of the factor, the gap with market rents is not narrowed easily. Page 22 indicates residence. New tenant rate and turnover rate are about 30%. Although they look high, they are within the range of our expectation. In the middle of the page, you see number of new tenants and departures. Below that, you see it says up and down. Whether rent was up or down as a result of tenant turnover is indicated. In the 21st fiscal period, new contracted rents of 192 residential units were up, and those of 337 were down. Compared to the 20th fiscal period, rents of more units were up. Below that, average rent levels are shown. Monthly rent per tsubo increased by 0.6% from 11,297 yen at the end of the 20th fiscal period to 11,368 yen at the end of the 21st fiscal period. It is not because total monthly rent per tsubo increased, but because occupancy rate of high-rent properties rose. At the bottom, you see the graph indicating present status by type. For example, occupancy rate of 40 square meters or below, 60 square meters or below, 80 square meters or below, and 100 square meters or below increased, pushing up the total rent per tsubo. There is still a gap with market rents. The gap improved to 2.39% in the 21st fiscal period from 2.78% in the 20th fiscal period. Lastly, I will talk about our future management policy. Please turn to page 24. In the 22nd fiscal period, we will continue our efforts toward the phase of regrowth in stage 2. As you see in the middle of the page, we will enhance cooperation with Heiwa Real Estate. By using power of the sponsor, we will continue to acquire high-quality properties like Hirokoji Agro Place. In order to increase profits, we will maintain high occupancy rate or increase occupancy rate. As for financial base, as indicated in the upper left, we will make a wholehearted effort to strengthen financial base, hoping to regain A credit rating at an early date. We would also like to make loans unsecured. On the other hand, our asset size and market capitalization are small. Low liquidity is pointed out. We would like soon to return to original growth model of J-REIT, under which we acquire properties by increasing the capital. That is our target. For that purpose, we have to boost our investment unit price. Having said that, there is no shortcut. Although the effort you see here seem very common, I think it is necessary to steadily deal with the challenges one by one. Going forward, we will utilize the comprehensive strengths of Heiwa Real Estate Group in real estate and endeavor to enhance unit holders' value. That concludes my explanation. Thank you very much for your attention.